Ladies and gentlemen, today we confront a moment that underscores a fundamental truth about power, money, and accountability. For years, influence and prestige have acted as shields, thick, polished, and seemingly impenetrable. But history shows that when facts are placed under oath and financial records are pulled into the light, even the strongest shields can crack. This case is not built on rumor or political noise. It rests on documents, transactions, timelines, numbers that either add up or don't. A major financial institution has now laid out evidence that alleges a pattern of misrepresentation so extensive that it cannot be dismissed as error, oversight, or misunderstanding. What is being described is systematic conduct repeated over time and allegedly designed to deceive. At the center of the issue is a simple question. When applications were signed, values declared, and guarantees offered, were those statements true? Banks do not operate on vibes or promises. They rely on verified disclosures, audited statements, and legally binding representations. If those inputs are false, the entire financial system is placed at risk. That is why fraud is not a technicality. It is a serious offense with serious consequences. We are told the discrepancies were not minor. Assets allegedly inflated here, liabilities allegedly minimized there, risk obscured, exposure hidden. Each distortion may appear small in isolation, but together they form a mosaic, one that prosecutors argue shows intent. And intent is the dividing line between negligence and criminal liability. This moment matters beyond any single courtroom. If financial rules apply only to those without power, then the system is not a system, it is theater. Trust in markets depends on the belief that contracts mean what they say, that disclosures reflect reality, and that no one is permitted to rewrite the truth because of status or wealth. The defense may argue complexity, they may claim aggressive accounting, industry norms, or reliance on advisors. But complexity does not excuse deception, industry norms do not legalize falsehoods, and outsourcing decisions does not outsource responsibility. Signatures carry weight, representations carry risk, and when those representations are proven false, consequences follow. The possibility of prison is not raised lightly. It emerges only when evidence crosses a threshold, when financial harm is alleged, when intent is inferred, and when accountability is demanded. Courts do not imprison reputations, they imprison conduct proven beyond reasonable doubt. That process is slow, methodical, and unforgiving to exaggeration. What we are witnessing is not vengeance, it is verification, not spectacle, but scrutiny, and it sends a message that reverberates far beyond this case. No balance sheet is above examination. No name above the law, and no amount of influence can permanently outrun documented truth. In the end, this is about the integrity of the system itself. When banks present evidence, when courts weigh it, and when the rule of law is allowed to function without fear or favor, society moves closer to fairness, not because outcomes are guaranteed, but because process is respected. Let the facts speak, let the evidence be tested, and let accountability, wherever it leads, remind us that justice is not selective, it is supposed to be exact. In this case, the foundation is not speculation, public emotion, or political framing, but verifiable evidence. Financial records do not bend to influence, and documents do not respond to reputation. When banks present internal files, audited statements, signed disclosures, and transactional histories, they introduce facts that exist independently of the person attached to them. These materials either align with reality or they do not. That is why evidence carries more weight than status. It is fixed, traceable, and subject to expert verification. Influence can shape narratives, but it cannot alter numbers once they are logged into systems governed by compliance rules and regulatory oversight. Every loan application, valuation report, and guarantee relies on specific representations made at a specific time. When those representations are reviewed years later, the context may change, but the record does not. Investigators can reconstruct intent by comparing what was claimed with what actually existed. That comparison strips away rhetoric and reduces the matter to accuracy versus deception. Banks are uniquely positioned in this process because they operate on standardized risk models. They do not extend credit based on personality or public image. They rely on ratios, collateral values, income projections, and exposure assessments. If those inputs are false, the output is corrupted. When a bank later demonstrates that it relied on information that was materially inaccurate, it establishes a direct link between the misrepresentation and the financial decision. This link is critical because it transforms questionable behavior into potential fraud. The power of evidence also lies in its cumulative nature. A single inconsistency might be explained away as error. Multiple inconsistencies, repeated across documents and over time, form a pattern. Patterns suggest intent. They imply planning, awareness, and choice. Prosecutors do not need dramatic moments or emotional testimony when the paper trail tells a consistent story. Spreadsheets, emails, and signed certifications can quietly dismantle claims of innocence with far greater force than public accusation ever could. This is why influence loses its protective value once evidence enters the legal process. Courts do not weigh popularity, wealth, or media reach. They weigh admissibility, credibility, and corroboration. Financial evidence is particularly resistant to manipulation because it is often supported by third parties, auditors, lenders, compliance officers, who have their own records and incentives to maintain accuracy. When multiple independent sources align, denial becomes increasingly difficult. The emphasis on evidence over influence also serves a broader function. It reassures the public that accountability is not symbolic. It demonstrates that the system is capable of distinguishing between noise and proof. If outcomes were determined by status, trust in financial and legal institutions would collapse. By centering the case on documentation rather than identity, the process reinforces the idea that consequences flow from actions, not from who someone is perceived to be. Ultimately, evidence levels the field. It places all parties under the same standard and demands the same explanation. Do the facts support the claims that were made? When the answer is no, influence becomes irrelevant, and responsibility moves from abstract debate into concrete legal risk. The issue described is not an isolated mistake or a single questionable judgment call, but an alleged pattern that repeats itself across time, documents, and transactions. Systematic misrepresentation implies structure, consistency, and purpose. It suggests that the same type of distortion appears again and again, indicating that the conduct was not accidental. In financial contexts, repetition is rarely random. Each disclosure, valuation, or certification is a separate decision point, and choosing the same misleading path at each point points toward intent. When misstatements occur once, they can be attributed to confusion, poor record-keeping, or misunderstanding. But when similar inaccuracies appear in multiple filings involving different assets in different moments, the explanation changes. Patterns create narratives of their own. They show how information was shaped to present a more favorable picture than reality allowed. Over time, these distortions compound, creating a financial image that is strategically constructed rather than honestly reported. Systematic behavior is especially significant because financial institutions operate on layered verification. Information passes through internal reviews, external audits, and regulatory checks. To consistently misrepresent facts within this environment requires persistence and awareness. It means falsehoods were not corrected when opportunities arose. Instead, they were repeated, reinforced, and normalized. That normalization is what transforms misrepresentation into an operational strategy rather than an oversight. The alleged conduct also reflects an understanding of how financial systems respond to information. Inflated asset values, understated liabilities, or selective disclosures are not random choices. They are targeted adjustments designed to influence lending terms, interest rates, or access to capital. This demonstrates an awareness of cause and effect. When information is shaped to produce a desired outcome, it strengthens the argument that the misrepresentation was deliberate. Another critical element of systematic misrepresentation is documentation. Each false statement leaves a trace. Emails, drafts, internal notes, and third-party reports can show how figures evolved and who was involved in approving them. When investigators compare early drafts with final submissions, they can identify where reality was altered. If those alterations consistently move in one direction, always more favorable, never more conservative, that consistency becomes difficult to defend. This pattern also undermines common defenses. Claims of complexity lose credibility when the same inaccuracies benefit the same party across multiple contexts. Reliance on advisors becomes less persuasive when final decisions repeatedly reflect the same misleading outcomes. Systematic misrepresentation suggests control, not confusion. It indicates that misleading information was not merely passed along, but curated. From a legal standpoint, systematic conduct is powerful because it supports inferences about state of mind. Criminal cases often hinge on proving what someone knew and intended. A pattern reduces ambiguity. It shows that the conduct was sustained long enough for awareness to form and for corrective action to be taken and ignored. Courts view repetition as evidence that choices were conscious, not careless. Beyond the courtroom, systematic misrepresentation damages institutional trust. Financial systems depend on the assumption that disclosures, while imperfect, are made in good faith. When misrepresentation becomes systematic, it threatens that assumption. It signals that rules were treated as obstacles rather than obligations. That is why such behavior attracts heightened scrutiny and severe consequences. It is not just about false numbers. It is about the deliberate construction of an alternate financial reality. Modern banking is built on trust formalized through law. When a bank extends credit, it does so based on information that is presented as accurate, complete, and made in good faith. Financial disclosures are not casual statements. They are legal representations, balance sheets, income statements, asset valuations, and risk disclosures form the basis on which banks calculate exposure and decide whether to lend, at what rate, and under what conditions. If those inputs are false, the entire decision-making process is compromised. Banks operate within strict regulatory frameworks designed to limit risk not just to the institution, but to the broader financial system. Capital requirements, stress tests, and compliance rules all assume that underlying borrower information is truthful. When false information enters the system, it does not remain isolated. It propagates through risk models, affects reserve calculations, and can influence how much capital a bank believes it must hold. This is why misrepresentation is treated as a systemic issue rather than a private dispute. Legal obligations in banking are explicit. Borrowers certify that information provided is accurate to the best of their knowledge. These certifications are not symbolic. They exist to create accountability and to allocate responsibility. When a borrower signs a document attesting to the truth of financial information, they assume legal risk. That risk is the foundation of enforceable contracts. Without it, lending would rely on guesswork rather than structured assessment. Trust is also institutional. Banks must be able to rely on representations without independently verifying every detail. While due diligence exists, it is not a substitute for honesty. If banks were required to assume that all disclosures might be false, the cost of lending would skyrocket, access to credit would shrink, and economic activity would slow. The system functions because good faith disclosure is the norm, not the exception. When misrepresentations occur, the harm extends beyond financial loss. It erodes confidence in contractual reliability. Other borrowers are indirectly affected because banks respond by tightening standards, raising interest rates, or reducing exposure. In this way, one instance of dishonesty can impose costs on many. That collective impact is why banking fraud is prosecuted aggressively. It is not merely about recovering money, it is about preserving the integrity of the system. Courts recognize this dynamic. That is why financial fraud carries penalties that reflect its broader consequences. The law does not treat false disclosures as paperwork errors. It treats them as breaches of trust with systemic implications. Even if a loan is repaid, the offense does not disappear. The crime lies in the deception at the point of decision, not solely in the outcome. Banks proving misrepresentation rely on showing materiality. They demonstrate that accurate information would have altered the lending decision. This establishes causation and underscores why truthfulness is central. If honesty would have changed terms, reduced exposure, or stopped the transaction entirely, then the misrepresentation is legally significant. Ultimately, the relationship between banks and borrowers is a structured exchange of trust backed by law. When that trust is violated through false disclosures, it undermines the foundation on which financial systems operate. The response is not optional. It is necessary to maintain order, predictability, and fairness in economic life. In financial crime, the central dividing line between civil error and criminal liability is intent. Negligence describes carelessness, poor judgment, or failure to meet a reasonable standard of accuracy. Criminal fraud, by contrast, requires proof that false statements were made knowingly, or at least with reckless disregard for the truth. This distinction is critical because the law does not punish mistakes in the same way it punishes deception. Intent transforms inaccurate information into unlawful conduct. Courts rarely expect direct admissions of intent. People do not typically announce plans to deceive. Instead, intent is inferred from behavior, context, and consistency. Repeated false statements, especially when they benefit the same party in predictable ways, allow judges and juries to conclude that the inaccuracies were not accidental. When the same misrepresentations appear across multiple documents and over extended periods, the explanation of coincidence becomes increasingly implausible. Financial cases rely heavily on circumstantial evidence to establish state of mind. Email correspondence, internal notes, draft revisions, and communication with advisors can show awareness of true values alongside public representations that contradict them. If accurate information existed internally but was altered before submission, that gap becomes powerful evidence. It suggests knowledge of the truth and a conscious decision to present something else. The threshold of intent is also crossed when opportunities to correct false information are ignored. Financial disclosures are often updated, revised, and reaffirmed. Each reaffirmation is a new moment of responsibility. Failing to correct known inaccuracies, especially after questions are raised or discrepancies identified, supports the inference that the misrepresentation was deliberate. Silence in such contexts can function as confirmation. Reckless disregard plays a similar role, even if direct knowledge cannot be proven, demonstrating that a person consciously avoided confirming facts that were obviously questionable can satisfy legal standards. Choosing not to verify numbers that appear inflated or inconsistent may indicate an intent to deceive by willful blindness. The law does not reward deliberate ignorance when the stakes are high, and the duty to be accurate is explicit. Intent also distinguishes aggressive behavior from unlawful conduct. Financial actors often argue that valuations are subjective or that optimism is part of negotiation. While some flexibility exists, it has limits. When valuations consistently exceed reasonable ranges without credible justification, or when liabilities are repeatedly minimized despite clear documentation, optimism turns into misrepresentation. Intent emerges from the gap between what could reasonably be believed and what was asserted as fact. This legal threshold exists to protect fairness. Without an intent requirement, any complex financial activity could be criminalized after the fact. With it, the law focuses on conscious choices rather than imperfect outcomes. It ensures that punishment is tied to deception, not to risk-taking alone. Ultimately, intent is the lens through which conduct is judged. It converts patterns into proof and inconsistencies into culpability. Once intent is inferred, the case shifts from questions of accuracy to questions of accountability. At that point, the issue is no longer whether mistakes were made, but whether the truth was knowingly set aside in pursuit of advantage. In cases involving alleged financial misconduct, defenses often follow familiar paths: complexity of transactions, accepted industry practices, or reliance on professionals. While these arguments may sound reasonable on the surface, they carry limited weight when examined against the obligations imposed by law. Complexity does not nullify responsibility. Financial systems may be intricate, but that is precisely why clear disclosure rules exist. The more complex a transaction, the greater the duty to ensure accuracy, not the lesser. Industry norms are frequently invoked to suggest that questionable behavior was standard practice rather than misconduct. However, norms do not override legal requirements. If a practice is widespread but deceptive, its popularity does not make it lawful. Courts evaluate conduct against statutes and regulations, not informal habits within an industry. What matters is whether statements were materially accurate and made in good faith, not whether others engaged in similar behavior. Reliance on advisors is another common defense, but it too has clear limits. Professionals may prepare documents, offer valuations, or structure transactions, but responsibility does not disappear once a signature is placed on the page. The act of signing affirms that the signer has reviewed the information and believes it to be truthful. Delegation does not transfer legal accountability. Advisors advise, principals decide. This distinction becomes especially important when evidence shows selective reliance. If professional advice is followed only when it supports favorable outcomes and ignored when it raises concerns, the defense collapses. Courts look closely at whether advice was used as guidance or as cover. Genuine reliance involves transparency, full disclosure to advisors, and willingness to accept inconvenient conclusions. Anything less appears strategic, rather than innocent. Claims of misunderstanding also weaken when the same inaccuracies recur. It is difficult to argue confusion when the same misstatements appear across different contexts and time periods. Repetition suggests familiarity. Familiarity suggests awareness, and awareness undermines claims that errors were accidental. The law expects learning over time. Persisting in the same inaccuracies indicates choice, not confusion. Another limitation of these defenses is material benefit. When misrepresentations consistently produce advantages, better loan terms, increased access to capital, reduced scrutiny, it becomes harder to argue that they were unintentional. Courts consider motive alongside conduct. Benefit alone does not prove guilt, but benefit combined with repeated misstatement and disregard for correction strengthens the inference of intent. These defenses are also constrained by documentation. Emails, drafts, and internal records can contradict claims of reliance or confusion. If internal communications reflect awareness of true values, while external documents present inflated or distorted figures, defenses lose credibility. Paper trails often speak more clearly than after-the-fact explanations. The law allows room for error, but not for abdication of responsibility. Complexity demands care. Industry standards demand compliance. Advisors demand honesty. When these elements are used to excuse conduct rather than explain it, they fail. Ultimately, signing false statements cannot be shielded by complexity, custom, or consultants. Responsibility remains fixed at the point where representations are made and affirmed as true. The principle at stake is not merely whether one individual is held to account, but whether the rule of law functions without exception. Accountability loses its meaning if it applies unevenly. Legal systems are designed to test facts through process, not to accommodate status, influence, or public standing. When scrutiny is applied consistently, it reinforces the idea that laws are obligations, not suggestions, reserved for some and waived for others. The rule of law depends on procedure. Evidence is gathered, challenged, and evaluated within defined boundaries. This structure protects both the accused and the public. It ensures that outcomes are based on proof rather than pressure. When high-profile cases are allowed to proceed through ordinary legal channels, it demonstrates institutional confidence. The system shows it can withstand external noise and remain anchored to standards of proof and fairness. Accountability also serves a preventative function. Enforcement is not only about punishment, it is about signaling boundaries. When consequences follow verified misconduct, others are deterred from similar behavior. This deterrence maintains order in complex systems where trust is essential. Financial markets, in particular, rely on predictability. Participants must believe that rules will be enforced consistently, or risk-taking turns into exploitation. The absence of accountability creates distortion. If certain actors are perceived as untouchable, incentives shift. Compliance becomes optional for the powerful and mandatory only for the rest. Over time, this erodes legitimacy. People lose confidence not just in outcomes, but in the process itself. Once trust in institutions declines, restoring it becomes far more difficult than preserving it in the first place. Equal application of the law also protects institutions from politicization. When enforcement decisions are grounded in evidence and process, they are harder to dismiss as partisan or arbitrary. Transparency and procedure, why charges are brought, how evidence is evaluated, and what standards are applied, reduces suspicion and reinforces credibility. The focus remains on conduct, not identity. Courts play a central role in this balance. They act as filters, ensuring that only substantiated claims move forward. This protects individuals from unfounded accusations while allowing legitimate cases to proceed. When courts insist on rigor, they uphold both justice and restraint. Accountability is not about assuming guilt. It is about allowing facts to be tested without interference. Institutional integrity is maintained through this consistency. Banks, regulators, and courts each have defined roles. When each performs its function without deference to power, the system works as intended. Failures in accountability are rarely isolated. They ripple outward, weakening confidence across sectors. Conversely, visible enforcement strengthens the entire framework. Ultimately, accountability under the rule of law affirms a basic social contract. It reassures the public that outcomes are determined by actions, not by influence. It confirms that legal risk is tied to behavior, not reputation. When institutions uphold this standard, they reinforce stability, fairness, and trust. Without it, rules become negotiable, and justice becomes selective.